Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study how they think. Today we're looking at an expert advisor called Variance Ratio Trend Regime. It's built around a classic piece of statistics, the Lo and MacKinlay variance ratio test, used as a filter that asks one simple question before any trade is considered. Is this market actually trending, or is it just noise? By the end of this video, you'll understand how that filter works, how the strategy sets its direction, and how it manages its stop and target. Let's get into it. So what does this expert advisor actually do? At its heart, Variance Ratio Trend Regime is a momentum strategy with a gatekeeper. Plenty of systems try to ride a trend, but they run into trouble when the market isn't really trending, when price is just drifting sideways and chopping back and forth. This EA tries to avoid that by measuring, statistically, whether the current market has real directional structure before it ever considers a trade. The measurement it uses is the variance ratio. The idea comes from a well-known test of the random walk hypothesis. For a pure random walk, the variance of returns grows in a straight line with the holding period. So the variance measured over 5 bars should be about 5 times the variance over 1 bar. When you divide one by the other, you get a ratio near 1. When moves tend to persist and feed on themselves, that ratio climbs above 1, which points to a trending regime. When moves tend to reverse, the ratio falls below 1, which points to a choppy, mean-reverting market. The strategy only looks for trades when that ratio is comfortably above 1. The EA runs on a single time frame, whatever chart you attach it to. A natural home is a liquid instrument such as a major currency pair, an index, or a metal, on something like the 15-minute to 1-hour charts, though it isn't locked to any one market. It works entirely on closed bars, acting once per bar rather than reacting to every tick. Who is it suited for in an educational sense? Traders who are curious about regime filtering, the idea of only engaging when conditions favor your style, and who want to see a statistical concept translated into working code. Remember, this is a study of mechanics, not a recommendation. All trading carries risk, and losses are part of the picture. Let's walk through the exact logic, step by step. Everything happens on a newly closed bar. When a bar closes, the EA records it and checks whether it has enough history. It needs the full rolling window of closes before it can do anything. First comes housekeeping. The strategy allows only one position per magic number at a time. So if a trade is already open, it waits and lets the stop and target manage that position. It also checks the current spread. If the spread is wider than the maximum you've set, in points, it skips the entry to avoid poor fills. Next is the core filter. The EA estimates the variance ratio over the most recent window of closing prices. By default, the last 81 period returns, measured over a horizon of 5 bars. It compares the ratio to a threshold. Only when the variance ratio -1 is greater than or equal to your threshold, a default of 0.15, does the strategy consider the market to be trending. If the reading falls short, it stands aside. No trade is taken in a random walk or mean-reverting regime, and that's deliberate. That's exactly where naive momentum tends to bleed out. Once the regime passes, the EA sets direction from recent drift. It compares the latest close to the close a set number of bars ago, 10 by default. If price is higher now, the drift is up. If lower, the drift is down. Then comes a confirmation step. The just closed bar must agree with the drift. For a long, the drift must be up and that last candle must have closed bullish above its own open. For a short, the drift must be down and the last candle must have closed bearish. This is the continuation candle idea. The strategy wants the most recent bar pushing in the same direction as the trend, not an exhaustion move against it. Finally, risk. The EA reads the average true range and uses it to place the exits. For a long, the stop loss sits below entry by 2 times the ATR, and the take profit sits above entry by 3 times the ATR. For a short, it mirrors stop above, target below. That's a reward to risk of 3 to 2, set automatically from volatility rather than a fixed number of pips. Once the order is sent, the position rides until either the stop or the target is reached. Let's read the actual MQL5 that runs on the chart. At the top are the input parameters you can adjust in the strategy tester. VR window, at 80, is the rolling sample of 1 period returns. VR lag at 5, is the horizon the ratio is measured over. VrThreshold, at 1500ths, is the minimum reading needed to call the regime trending. MomentumBars, at 10, is the lookback for direction. ATR period sets the volatility length, and AtrSlMult and AtrTpMult, at 2 and 3, scale the stop and target. There's also a maximum spread filter, a fixed lot size, and a magic number to tag the trades. Below that is the decision block. The variable named trending checks that the variance ratio -1 clears the threshold. Drift is simply the current close minus the close from momentum bars ago. Bullish and bearish flag whether the just closed candle finished above or below its open. Put together, go long is true when drift is positive and the candle is bullish, and go short is true when drift is negative and the candle is bearish. Now look at the two signal blocks on screen. When go long is true, the EA reads the ask price as entry, sets the stop loss 2 ATR below and the take profit 3 ATR above, and calls trade.buy with the fixed lot size. When go short is true, it reads the bid price as entry, sets the stop 2 ATR above and the target 3 ATR below, and calls trade.sell. Both sides are symmetric, same structure, opposite direction. And notice both stops and targets are normalized to the symbol's digits before the order goes out. That's the whole engine, right there on screen. Now let's bring it to life on a chart. Up top you can see the price candles, and below them a subpanel plotting the variance ratio itself. Two reference lines matter here. The lower line, at 1.0, is the random walk mark, the reading you'd expect if price had no exploitable structure. The upper line, at 1.15, is the trending line, the level the ratio must clear before the strategy will act. When the variance ratio is riding above that upper line, the market is considered to be trending, and that's shown as the shaded trending zone. Look at the first few candles. Price is drifting sideways, ticking up and down without commitment, and in the panel below the variance ratio is sitting under the trending line, even dipping toward and below the random walk mark. This is exactly the kind of choppy, indecisive market the strategy is built to avoid. No matter how tempting a small move looks, the gate is shut, and the EA simply watches. Then the character of the market changes. A run of stronger candles begins to build, each one closing higher than the last, and in the subpanel the variance ratio starts climbing toward the trending line. Still, nothing happens yet. The reading hasn't cleared 1.15, so the strategy holds its patience. On the next candle, two things line up. The variance ratio pushes above the trending line into the shaded zone, confirming a trending regime. At the same time, the drift over the last 10 bars is clearly positive, and this just closed candle finished bullish, closing above its own open. Trend confirmed, direction up, continuation candle in agreement. That's where you see the buy entry marker appear. At that moment, the strategy places its stop loss 2 ATR below the entry and its take profit 3 ATR above, a reward to risk of 3-2. Watch what happens next. The uptrend keeps its footing. The following candles push higher, the variance ratio stays comfortably inside the trending zone, and price marches up toward the target. A couple of bars later, price reaches the take profit level, and you can see the first take profit marker. The long position closes out at its target. That's one complete cycle. Wait for structure, confirm direction, ride to the target. Now the market shifts again. Momentum stalls at the top, and a couple of candles roll over to the downside. Notice the subpanel. As the trend transitions, the variance ratio slips back below the trending line, sinking toward the random walk mark. During this in-between stretch, the gate is shut once more. The strategy doesn't try to catch the exact top or fade the move. It waits for the new regime to prove itself. And it does. As selling takes over, a fresh run of lower candles forms, each closing beneath the last, and the variance ratio climbs back above the trending line. Here's the key point about this filter. It measures trend strength in either direction. A strong downtrend produces a high reading just as a strong uptrend does. So when the ratio clears 1.15 again, the drift over the last 10 bars is now negative, and the just closed candle is bearish. The sell entry marker appears. This time the stop loss sits 2 ATR above the entry and the take profit 3 ATR below, the mirror image of the long. From there the downtrend carries on. The candles step lower, The variance ratio holds inside the trending zone, and price works its way down to the short target. When it arrives, the second take-profit marker prints, and the short position closes. So across the whole sequence, you've seen the same rules applied symmetrically. Stand aside in noise. Engage only when the variance ratio confirms a trend. Take direction from drift and the closing candle, and let the ATR-based stop and target do the managing. So that's the Variance Ratio Trend Regime Expert Advisor. We've covered the idea behind the Lo and MacKinlay variance ratio, how the strategy uses it as a gate to separate trending markets from noise, how it sets direction from recent drift and a continuation candle, and how it manages every trade with an ATR-based stop and target. Hopefully you now see how a statistical test can be turned into a clean set of trading rules. Remember, everything here is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. All trading involves risk, and losses do happen. If you found this breakdown useful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.